So in 6.3, talking about mortgages, and mortgages are just a fancy word we use for home loans, so they're just another type of loan. And if you remember, if we go way back to chapter 3, or unit 3, I suppose, where we talked about loans and credit, we hinted at this as a type of loan. So a lot of it will sound familiar if you remember our discussion from that chapter. But a lot of the terms and definitions that we also talk about specific to mortgages can be different, can be unfamiliar, and can sometimes be confusing. So we're going to start there. So just some general vocab to start. The market value of a house is the amount that we would anticipate a house being sold for. Right? This isn't necessarily the actual selling price, but it's kind of a gauge to say, if we were to put this on the market, this is where we would estimate maybe selling it around, comparable to other data that we have for the area. So some of the factors that could impact that are things like the curb appeal. So what is curb appeal? This is just kind of judging a book by its cover, right? This is what it looks like from the outside. How does the house look from the street, right? From the curb. The size and number of room, obviously the bigger the house, generally the more expensive it is. And then we have comparable houses in the area. If you've watched like home renovation shows, sometimes you hear them talk about comps, and that's exactly what this is, right? Other houses in the area similar to the one that I'm looking at or selling, what do they go for? What's their market value? Or if they just sold, what did they just sell for? Then, of course, we have supply and demand. So if you think all the way back to supply and demand in the very first chapter we talked about of the year, the same type of things apply. So we're talking about the housing market here. And maybe I'll just move it up to the top here. So if we talk about the housing market, then we're really looking at two big things. You could either have what we call a buyer's market, which just means essentially we have a surplus of houses. So we have more houses for sale than we have people willing to buy them, right? Which is great for the buyer because the sellers are trying to get the houses off the market and be competitive with others. So the prices may generally be lower. This is what we would call then, if you remember from the first chapter, high supply, right? An excess supply is a surplus. Alternatively, we can have a seller's market, which would be the opposite case. We have excess demand, so we have more people willing to buy houses than there are houses to be bought, right? So the sellers can really start to play with that and say, well, I've got a whole bunch of other people looking to buy this house. How high are you willing to buy this house for? And this works out in the seller's favor, obviously, because they make more on the sale. So this would be high demand. And this market fluctuates crazy. So right now, at least around here, we are experiencing more of a seller's market, right? Where there are more where there are more people on the market looking for houses than there are houses being sold. So this is why housing prices tend to be more expensive right now, because sellers can look at that and say there's a high demand. People are going to want to be competitive, be the first one to buy this house. So I can raise the price a little bit and really weed out the people who aren't being serious. One of the best times to buy would be obviously during a buyer's market, right? You have a surplus of houses. You can usually bargain a little bit more and say, well, I know I'm the only one looking at this house because there are way more houses similar to this one that are on the market. What can you do for me to get this house off the market and into my possession? So that's kind of what we're looking at with supply and demand, which is, like I said, why you see housing prices rise and fall with times. And of course, the location. Things like not just obviously the city and town. So maybe I don't know, I'm running out of space here. Maybe I'll do it down here, right? Not just the city or town, but also features of the property. So like, what neighborhood are you in? Things like water will absolutely drive up the price or market value of a house, things like that, all things to consider with location. And then, of course, the assessed value. So we have two different types of valuations of the home, right? We have market value here, and then we have assessed value. And assessed value is usually done by the city or the town, by the tax assessor. Every city or town has a tax assessor that levies the property taxes, and they go through, they assess your house, they actually come inspect your house sometimes. And usually they take a percentage of the house's market value, and it can be something like, some cents per, say, $1,000 of the house's market value. And that's how they determine their property taxes. So the property taxes. So every city and town, this is actually public information, right? Every city and town has a tax assessor. There's a database, which is usually public record if you know how to look for it. And you can go on, look up the address of your house and see, the valuation of your house. What was your house last assessed at? How would they tax your house? And see all the factors that go into determining your property taxes on your piece of land. So, of course, I mentioned property tax, right? Property tax is what we call a municipal tax because it's levied by the city or the town, right? So we call that a municipal tax. And it's based on, obviously, where the property is located, or usually by where the actual, address is. So if you have a property that sits on the border, say, of North Kingstown and South Kingstown, but your zip code is North Kingstown, then you are paying North Kingstown taxes. And as I said before, this is based on the value of the owned property, right? Based on the value of the owned property by the assessed value, not the market value. These are usually looked at as separate things. So a couple other terms really quick. Amortization is just a fancy word for paying off your loan. Right, you can see right here from the definition that I pulled right off of Google, amortization is just the action or process of reducing or paying off a debt with regular payments. So you're paying off a debt, it's right in the definition. And then with regular payments, right? So this tells me that I have an installment loan, not a line of credit, right? I have an installment loan. I have some kind of big balance that I'm trying to pay off by making monthly payments. Maybe I'll do my monthly payments in a different color, right? By making monthly payments every month to pay down this loan and pay off the balance of the loan, right? So this is an installment loan. I have regular payments. And then we talked about escrow in the last section, right, in 6.2. My numbers up here are backwards because I renumbered all my units this year. So this is 6.3, it is correct. Escrow, as we talked about, is some other document that's kept in the custody of some some non-involved third party that takes effect only when a specified condition has been fulfilled. In our case, with houses, this other document is cash, right? We said usually 1 to 3% of the sale price of the house, kept in the custody of the third party, which is usually, in our case, the bank, and taking effect, meaning it gets applied to the loan, or you get to access it at least, only when a specified condition has been fulfilled. Let me keep my colors consistent here. And that specified condition is officially closing on the home. Closing on the home. So you formally become owner of the house. Usually, again, like I said, this is cash. And you can think about this more like a security deposit, or more like some kind of a a safety deposit than a down payment, right? This isn't really an additional down payment as much as this is kind of like some kind of a security deposit on the home. So mortgages. There are a lot of mortgages. There are a lot of types of mortgages. They can get awfully confusing. We're going to focus on 3. We're even really going to focus on 2. The third one I'm just going to touch on. So the fixed rate mortgage is exactly what it sounds like, right? If we remember back from our 3rd unit, right? If we remember back from unit 3, we talked about a home loan. We said this is 3 things. It is a secured loan because there is collateral, which is your house. If you don't pay your mortgage, they will come and take your house away. It is an installment loan, right? Because you are paying it off, or we just call this amortization. You're amortizing it. And when we had talked about this original, we said, is this a fixed or variable interest rate? And I said, well, it depends. Right? It kind of depends. It depends on what? Well, it depends on the type of mortgage you take out. So the short non-committal answer is it's both. Sometimes it's a fixed interest rate. Sometimes it's a variable interest rate. And we're going to talk about that right now. And honestly, sometimes it could even be both at the same time. So a fixed rate mortgage is exactly what it sounds like, right? It's a fixed interest loan. The monthly payment and the interest rate, I'm just going to use, remember I'm just using APR as my abbreviation for interest rate, annual percentage rate, interest rate, remain constant throughout the entire duration of the loan. We're talking 30 years usually. Adjustable rate mortgage, sometimes shortened to ARM, right? So adjustable rate, well, that's as it sounds, is variable. Sometimes it's called ARM. So this just means that the monthly payment and the APR may change. That's a typo that I did not catch. So they may change based on the terms outlined in the signed agreement. Additionally, they also may change based on the housing market. So your interest rates may go up if the housing market changes. And this would be the terms that are outlined in the signed agreement. Right, somewhere in our terms and conditions here, it would say, this is how we could possibly change your interest rate. If we have to give you notice, this is how much notice we have to give you before they change your rates. Here are your outs if you choose to refinance with somebody else or for a better rate. These are all things that are lined out. Terms and conditions are something that we often just kind of laugh about and write off, not with something like this. So do not just agree to the terms and conditions, right? This isn't like, signing up for Instagram or something where like, oh yeah, sure, I agree to the terms and conditions. Like, that's not this. You should absolutely read every letter of the legal documents that you were presented with, because you could be in some serious legal trouble and not even know it. So the last one that we're going to talk about is a balloon mortgage, and you're probably thinking, why are we talking about a balloon mortgage or a balloon? Smaller payments are made initially where the last payment is significantly larger. So if we think about a balloon, right, and we think about blowing up a balloon, right, so I've got like my deflated balloon here. And how do I get from this balloon to that balloon? Well, I blow it up, right? I'm putting air into it. In this case, if you think about the size of the balloon as it grows, this is all one very far-fetched metaphor, but it works, I promise. Right, somewhere along the way, I have my balloon in the middle, and that models the way that this mortgage payment plan works, where originally, maybe I'm making smaller payments to start, And then as I go, I'm paying slightly larger payments over time, where by the time I get to my last payment, I'm paying quite a bit of money. Well, what's the point of this, right? These are similar to, if you remember talking about student loans, we talked about graduated repayment plans. Whoops. Where the same type of things happen. You start with smaller payments and work your way up. These are especially good mostly for businesses, right? If you think about a business that instead of just renting out a property, they actually buy the property. Um, I can think of the first one that comes to mind is when Feast was open on Main Street in East Greenwich. If you've ever been down there, this is a super specific example. But if you've ever been to Feast in East Greenwich before it closed and it's got replaced with something else, but it looks like just a house, right? It's not like a piece of a bigger property. They most likely own that and then paid a mortgage on it until they got caught for tax evasion and then had to close. There are a lot of costs that go into owning a business. We talked about this at the beginning of the year, and it might be smart, it might be better off, to focus on the other costs and building a profit back up to repay those original startup costs. So to not focus on the mortgage at first with like a smaller payment would be best. And then as your business grows, you're able to make more money, you're able to manage your expenses better, you're able to handle this big final payment. So this is really good for businesses. This isn't really a viable option, nor I think is it an option at all for just your standard issue average homeowner or home buyer. But if you ever think about getting into owning a business, you might actually consider one of these balloon mortgages. These are a little bit harder to plan for, obviously, because the payments do change. But for a lot of people, they may be beneficial. So we want to talk about what goes into the actual application process. How do I actually get approved for a mortgage? Well, because this is such a significant financial move, right? This is such a big step in your life financially, or just at all. They're not just going to look at your credit score, right? Your credit risk score and even your credit report don't really provide a whole lot of information. Right, they tell you, how you are with paying your debts. They tell you what kind of debts you have, but they don't tell you how much you have relative to how much you make. And they don't tell you if it's really viable for you to take on more debt. So those are some of the things that are kind of left out, right? So we want to come up with a better way. Right, we want to come out with a better way. So we've devised two things. The first is front-end ratio. And front-end ratio calculates how much of a person's gross income monthly is going towards specifically housing costs. And again, this is just monthly. So we're looking at the ratio of housing expenses, specifically housing expenses, to your gross income pre-tax. So the question that this kind of answers is this house an affordable option? Right, how much of my income am I going to wind up having to shell out to to this house? And can I actually manage that, right? If I think about other debts, other things, just to start thinking about it, there's a lot of other people you have to pay, right? You have a credit card bill, you have a car loan, you have sometimes a student loan, you have car insurance, health care, all these things. So the bank says, well, if you exceed a certain percentage, and this, to my knowledge, varies by bank, or sometimes they give you like a range instead. Um, they say, well, okay, well, if you fall in this ballpark, then you should be in good hands. Maybe it's a little bit high, maybe it's a little bit low. But we definitely want you maybe around like the 28% range, and I don't know, maybe like plus or minus 5. So somewhere in like the 23 to 33% range, because then that would say that about, right, a quarter to a third of your monthly income is going to paying for your house, which isn't bad, right? If you wind up in the 50s, where half of your income is going to your house, that's probably not the most financially wise decision. We'll come back to how to calculate this in a minute, but the other one I want to talk about is back-end ratio, because these are kind of similar, but different. So back-end ratio looks at more than just, more than just your housing debt. They look at everything. Right? How much am I putting toward everything? My monthly debt expenses versus my monthly gross income. So how much am I already putting toward all of my other loans? The question that this answers for the bank is not a how, sorry. It's, can I afford to take on more debt right now? Right? This house might be affordable. It might have an appropriate back-end ratio. But if my, front-end ratio, but if my back-end ratio is too high, then I can't afford to take on any more debt. So same idea, the bank looks at this and says, all right, well, maybe if you're in like this 36-ish% range, and maybe they say plus or minus 5, this plus or minus 5 is arbitrary. This is something that I just kind of came up with because I say ballparking and then I give you a figure. But let's just say 36-ish, and maybe you're like 5 plus or minus 5 to that, right? It's not exactly 36. It's not a hard cutoff. All right, well, this tells you that, all right, maybe about 40%, a third to 40% of your current monthly gross income is already being applied to debt. So if I think about this, right, if I have my 36% on the back end and I have my 28% on the front end, well, then I'm looking at, 64% total in debt that I'm paying off, right? This is a little less than 2/3 of my monthly gross income, which is good, right? This leaves me about a third then for other things, for things like food and gas and Netflix and whatever. So we'll talk more in the budgeting section, in the budgeting unit, about what this really means. But that's kind of what we're going at with this front end and back end ratio. Again, we'll come back to how to deal with those, how to calculate and interpret them later, but I want to take a minute first and go through just a couple other terms first. So a couple other mortgage-related terms. The first one, and the one that you tend to hear a lot about, is home equity. And this is something that's going to play a role when we talk about the Great Recession in 2008. We'll preview it later. But what home equity is talking about is really just essentially the market value of your house minus what you owe on the house. Right, I'm going to take the market value and subtract out your mortgage balance or your loan balance. And we would hope that this is a positive number, because that means that I actually have value on the house left over, so to speak. A preview of what happened in the recession, the market value of the houses became less than what people owed on the house. So you effectively have, right, negative home equity, so to speak. And it's what we call being underwater on the house, where you actually owe more than the house is worth. That is bad. That's not a good thing. It's what led to a lot of the economic downturn in the recession in 2008. So ways that your equity can increase is, well, the first big thing is if you're talking about your loan balance, you should probably try to get your loan balance down, right? So paying off your loan principal is going to help. And obviously doing things to get your market value of the house up too. So maybe you renovate, maybe you do some landscaping in the front yard, you put a pool in the back, things like that, right? Things to drive up the market value that you can control, right? You can't control where your house is placed. You can't control whether or not it sits on a lake or the ocean, but you can improve its curb appeal. You can add to the number of rooms. You can do things that way aesthetically to improve the market value of the house. So all of these things are going to help you actually increase your home equity. All right, well, that's great, but who cares? Well, the important thing is that this difference can become a line of credit. And you can actually borrow, the bank will let you borrow on this line of credit, and we call those home equity loans. And there are also home equity lines of credit. And if you remember from our discussion on loans in Chapter 3, these are two very different things, right? A home equity loan, to kind of preview this video right here that I'm going to have you guys watch, this part is your assignment. A home equity loan obviously is going to be some kind of an installment loan. Maybe I'll spell that out. Right, so you borrow a certain amount on the home equity and then pay it back, versus your line of credit, which is a revolving account, right? You can think about it almost like a credit card. I have this much that I can borrow on, and as long as I pay it back, I can keep using it. The last thing, unrelated, is homeowners insurance, and this just ensures your home structure and belongings in the case of some sort of destructive event. Big thing. We're talking like big catastrophic. We're thinking like hurricane. We're thinking like earthquake. We're thinking like blizzard, fire, theft, I think. You know, but what's the most important to a lot of people here is this belongings clause. You can insure items on the house. So the example that I always like to use is, as a musician, my instruments are, rather expensive. So I have my instruments, my piano, my clarinet, my mom's viola and violin are all insured on our house as part of our homeowner's insurance, so that if something were to happen to the house and the instruments were to get damaged, we're still covered. We call these riders. We'll talk about this in more detail in the next section, so I'll just say more on this later. End of tangent. So lots of terms and vocab, lots of things that I just threw at you all of a sudden, but starting to get an idea for the differences when we talk specifically about mortgages versus any other type of loan.